Good afternoon, and welcome to the Real Estate Investing in 1031 Exchanges in DST webinar. On behalf of myself, Leah Chrisman, conference producer, Linda Chrisman, owner of the Mid-Atlantic Real Estate Journal, and Ronald Shapiro, producer of today's event, we would like to thank you all for joining us this afternoon. As you may know, the Mid-Atlantic Real Estate Journal is a commercial real estate trade, print, and digital publication. We have a readership of over 25,000 industry professionals throughout the Mid-Atlantic region. I would like to thank our sponsors for today's event. Without their support, this conference would not be possible. Thank you to our title sponsor, K Properties and Investments. I would like to introduce the moderator of today's event, Ronald Shapiro. Ron is Assistant Professor of Professional Practice, Finance, and Economics Department at the Rutgers Business School. He teaches real estate finance, investments, and financial management courses on the Newark and New Brunswick campuses. Prior to Rutgers Business School, Ron was Senior Vice President with Connect One Bank. If you have any questions throughout the webinar, please send them directly to Ron. Now, please welcome Ron and his amazing expert speaker.
Thank you, Leah. Good afternoon, everyone. We are pleased to present this afternoon Betty Friant, Senior Vice President of K Properties and Investments, LLC. Betty will present real estate investing in 1031 exchanges and Delaware statutory trusts. A little background on Betty. She oversees the firm's Washington, D.C. office. She has an extensive background in commercial real estate and expertise in investment sales. She specializes in 1031 tax-deferred exchanges. With more than 35 years of real estate industry experience, she holds the coveted CCIM designation. I would also like to thank Betty and her firm for her sponsorship and her participation in today's program. With that, here's Betty.
Thank you very much. It's a pleasure to be here. And as you know from talking to me earlier, it's really a passion of mine, real estate is, and also DSTs. The 1031 exchange has been in the news a little bit lately, so we'll be addressing that at the end. But what we'll do to start is actually go through the basics of 1031 exchanges and the basics of the DST, Delaware Statutory Trust, which is one of the ways that you can do a 1031 exchange. So I will share my screen right now. We are here and you can see the screen, right? Perfect. Okay, so education is just so important to K Properties and Investments. It's one of the reasons why I joined Dwight K's firm, is their commitment to education, their commitment to making sure that our clients really understand not only the 1031 exchange, but also the DST structure. And we spend a lot of time with our clients talking about that. We also spend a lot of time and effort on white papers and videos and blogs that you can read about later on kpi1031.com. So it's going to be a valuable resource for you to check out our website at some point. But to start, the 1031 exchange, we'll start with an overview of that, since many of the people who are doing DSTs are doing it because they want to affect their 1031 exchange. In the rule for the 1031 exchange, what we're really looking at is the fact that a property, any property really that's held for trade or business or investment, can be exchanged for another property that's held for business or trade or investment. So what happens, it's much like the old days when you could buy a house, and if you wanted to buy a more expensive house, you wouldn't have to pay taxes on that gain. Same here, as long as you buy for more, equal or greater than the property that you're holding, and you use it for investment or business, then you are able to defer those taxes until a later date, which is always a good thing whenever we can defer taxes. The basics of the 1031 exchange, you could do a full deferral by replacing your sales price, but there's a number of rules that will go into your putting together your 1031 exchange. And you can do a partial exchange where you pay taxes on some of the money and not on the rest. So the first thing is that you need a qualified intermediary. The qualified intermediary is the company that holds your funds. If you were to take a check at settlement or walk away with cash or any other way, take constructive receipt of the dollars, then you would not be able to do a 1031 exchange. It has to go to a qualified intermediary with arm's length transaction. As I mentioned, you can invest 100% of the proceeds, or you could do a partial exchange. A full exchange would be to invest equal or greater value. And then there's some strange rules that the IRS has come up with. One of them is that you have to identify the properties that you are thinking about buying within 45 days of your settlement date. So it's not a rule that can be changed. If it comes on a weekend or a holiday, it's still 45 days. That is your day at 11:59 p.m. So it's something that you have to pay very, very close attention to. Once you've identified the property, or even before, you have 180 days from your settlement in order to actually go to settlement on the replacement property. What that allows is time for you to do your third-party reports, to get it under contract, to get to settlement on that property sometime within that 180 days. So the timeline basically looks like this. You exchange, the exchanger is the person who is doing the sale. So they sell their old property, which is often called a down leg, and the qualified intermediary holds those dollars. You then have 45 days to identify your other properties and the 180 days for the total completion of the sale. There's 3 different rules that I'll mention briefly, and we can go into detail later if anyone's interested. But the first rule that most people are familiar with is that you can identify 3 properties of any price range. So you could, if you sold $1 million property, you could identify $1 million Dollar General, you could identify a $2 million apartment complex, and you can identify another property of any amount. And that works very well. If you have the mind to do some diversification, then you might look at the 200% rule. And that one says you can identify up to twice your sales price, 200% of the fair market value of your relinquished property. And it can be any number of properties. So you could identify 300,000 on one property, 5 on another, 700 on another, $1.4 million on another, as long as you don't go over twice your sales price. So those are, and then there's a third rule that's hardly ever used called the 95% rule, where you can identify any number of properties and you have to go to settlement on at least 95% of those. So what does the like-kind property mean? It's actually a rule that started about 100 years ago in 1919, actually, and it was mainly a process back then for farmers to be able to true up their land a little bit. They could trade off some of their farmland to another farmer, and because they were selling a property and buying a property and not really getting any cash in the middle, the IRS ruled, rightly so, that they should be allowed to defer that gain. They weren't getting any money from it. It was just changing hands, kind of like a barter system. So it's been in play for these 100+ years and continues to be in play for now, at least. We'll talk about that in a bit. Examples of what you can do on a property: you could identify or you could sell a beach house that you had for rent and buy raw land, or sell an apartment building and buy an office building, or any other types of trade. As long as that property had been held for business or investment, then you can buy any other type of property for business or investment. And we'll be talking today about the Delaware Statutory Trust property, which was also blessed by the IRS as a like-kind property back in 2004 with a revenue ruling. So it's been gaining in popularity since that time. An overview of what we're looking at is that, again, the 180 days and the 45 days are just critical. If you miss those deadlines, you've missed your exchange and you won't be getting that deferral. You'll have to look at something else, perhaps like a qualified opportunity zone, which would allow you to salvage a tax deferral if you don't get your 1031 exchange in place at the time. I mentioned that price matters. If you don't do the whole exchange, down here we have the word boot. So if you sold for $1 million and replaced 800,000, you would have 200,000 in boot. We also have an idea that we have to contend with that's called mortgage boot. So when you sold for $1 million, if you had $300,000 in loan, when that property got sold on your settlement statement, you would have paid off the bank. So you paid off the bank, you have 700,000 in cash at the qualified intermediary, but you had a $300,000 loan. That $300,000 loan has to be replaced, meaning you have to replace your sales price. You sold for $1 million, you have to buy something for $1 million, less allowable expenses, but for now we'll just say sales price for sales price. So you could bring 300,000 to the table to bring your sales price of the new property back up to $1 million, or you could get another loan for that 300,000. And by doing that, you would avoid that mortgage boot. So again, always important to think about that. You have to use that qualified intermediary again. And then you also have to think in terms of who sold that last property. If you owned that last property as a husband and wife or an individual, then you would buy typically the next property as a husband and wife or individual. If you owned it as a corporation or an LLC or a partnership, again, that entity is the one that would be going forward to buy the next property. There's some nuances about that, and you should always ask your CPA or attorney if you have questions about how that might work, but that's basically what you're going to be thinking of at this point. We have frequently asked questions. It seems to be a really good way to explain what a DST is, and so I'll go through those now. And again, I think, Ron, you're going to wait till the end to interrupt me with questions, so we'll just plow through. A DST property is a type of property where you own a piece of the pie instead of owning the whole pizza. So if you were looking to buy something like an Amazon distribution center, it might cost $100 million to buy that property. I know I couldn't afford to do that, but I could perhaps invest $100,000 in that same building and get the same type of cash flow, current cash flow from that building, and get the same type of ownership benefits that I would as if I owned regular real estate. So I'm owning a piece of the property instead of the whole thing. I own an interest, a beneficial interest in the trust, and the trust owns the property. As I mentioned, the DST was approved by the IRS as a like-kind property, so it makes it very convenient to be able to get a little bit of diversification, or just to know that you'll be able to affect your exchange within that 45-day period. So the DST is an entity that's used to hold title, and it is similar to an LLC, but the LLC, if you were to try to buy into a partnership or buy into an LLC or a syndication, unless it's a DST or a TIC, a tenant in common, it wouldn't qualify for a 1031 exchange. So that's certainly another way to hold real estate. But in this case, if we want to do the 1031 exchange, it has to be one of the two. How does it work with distributions and with the appreciation? So if the property that is the DST is giving a particular cash flow monthly, what happens is if you own 1% of that building, you get 1% of that cash flow. Typical cash flows for a DST are somewhere between the 5 and 7% range, not counting any tax efficiencies, the depreciation that you get to write off or the interest write-off. So it's somewhere in that range, and you would be receiving your piece of it. So if you had a 6% current distribution on a $100,000 investment, that would be 100,000 times 6%, which is 6,000, and it's paid monthly typically. So that would be about $500 a month on that $100,000 investment. The same thing happens at the end of the property when the property is sold. Investors will get 100% of their pro rata share. If you owned 1% or 5% of that building, you would get that 1% or 5% of the proceeds after the closing costs are paid off on the sale. And it's different from other syndications that you might have heard about. Sometimes you'll hear about LLCs or REITs or limited partnerships where there's a preferred return to the developer, or a waterfall, it's called. And that's where the developer might get 70 or 80% of the profit before the investors get their return, or they might just get 20, 25, 30% of the return. In the DST, it's basically like owning property. You get your share of the proceeds. When it's sold, typically our investors will do another 1031 exchange. And so if that happens, you can do the 1031 exchange into another DST if you liked the way it worked the first time, or you can do a 1031 exchange into a whole property again. You could go back and buy a rental property or a Dollar General, whatever you might be interested in. Or there's a couple other options that you have. You could pay tax on your dollars, meaning you could just tax out at that point and go ahead and get your money. And then there's a fourth choice where a number of the DSTs will offer the option to go up into a REIT. And we won't get into that in too much detail here unless you have questions specifically about that, but that just gives you the option to choose to go into a real estate investment trust instead of doing a 1031 exchange. And the up REIT, it's called, which is a 721 exchange, is also a tax deferred moment. You won't be paying taxes on your gain until you happen to sell that stock in the REIT. So it's another way to defer your taxes. What I love about the DST model and why I started offering it to my clients is just the fact that I don't want any more management in my life. I've owned real estate for years and still do, and I am not one that just enjoys that call on Thanksgiving when someone's oven goes out or the heat's not working or something doesn't work. I want somebody who's a professional manager to be the one to be taking those calls and managing that process. And it's even with COVID, it's even more prevalent now because large companies like Starbucks actually sent letters to their landlords during COVID saying that they didn't think they had to pay their rent anymore for the rest of the year. And when that happens, if I owned a Starbucks, I'd have to hire a high-powered attorney to be negotiating with or arguing with the tenants and attorneys. And that's just not something that I want to do. I like to know at some point I don't have to worry with management of my own properties anymore. So how easy is it to get into a DST, whether it's a 1031 exchange or it's a cash investment into a DST? For usually about $100,000, you can get into a DST. There's some that are a little bit less and some that are more, up to $1 million, but there are many that are the $100,000 range. And the DST, when I was talking about the current cash flow, that wasn't taking into consideration the tax advantages, the efficiencies that you get from doing the depreciation deductions and any interest write-offs that you might have. The diversification is something else that's really a strong suit for the DST. If you bought one property in one location and that property happened to not work out, say your tenant went bankrupt or they moved out, or you bought a beach house and that beach got that red tide or something and no one wanted to be there for a number of years, so you weren't getting rental income. With the DST, you can diversify into many different asset classes like multifamily, office, industrial. You can diversify according to different tenants. Even if it's industrial, you might want one with a FedEx, one with an Amazon, one something else. You can diversify geographically, not putting all your information, all your properties into one location. And then we also can suggest that you diversify by companies. We are able to show you many, many companies who are called sponsors who actually put these together. And much like going out to buy a new home, if I were showing you new homes from different big builders, I'll be showing you different DSTs by different sponsors so that you can have some perhaps that have debt on them, some without debt, different locations, even different time frames on how long the hold might be. Something like a self-storage might be sold in, say, 5 to 7 years, an apartment maybe 7 to 10, could be a triple net property with a longer term lease, might even be a longer hold. But in each case, the DSTs come with a business plan that gives you an indication of when they think they might sell. Now that thinking they might sell is part of my 8-ball, my crystal ball, just because of the fact, if they think they're going to sell it in 5 to 7 years, but it turns out that we're in a recession in 5 to 7 years, the sponsor is likely not to sell at that point. They're more likely to just hunker down and say, let's keep the income coming and just go on about our business until the market recovers. So all those are ways you can diversify. At the end of the year, another interesting feature of the DST is that it's not a K1. It's a little simpler than that. It's actually a 1099 that shows you your gross income for your portion of that ownership. So you would have on your end of the year forms, you would see what 100% of the property does, and you would see what your 2% of the property does. So you'd have the gross income, then you'd have a statement showing your income and expenses so that you would get to your bottom line. And the bottom line is the net operating income. It goes on your Schedule E, just like a regular piece of real estate would do. So at the bottom line on that Schedule E, when you see the net operating income, you're going to be, if you divide it by the number of months you held it, that would be basically your monthly income that you received from that. The financing on a DST is another really nice solution for a 1031 exchange. If you had to replace debt, then what you have to do is go to a lender and apply for a loan if you're buying a whole property. In a DST, the lender is already in place. The loan is already in place, and it's a non-recourse loan, meaning if something did happen horrendous to the property, it went bankrupt, the lender could come back and take the property if that were to happen, but they couldn't come after you the way they might if you got your own loan on a property. So that protects you, it helps mitigate your risk, and it also helps with that 45-day time frame, because these are properties that are basically on the shelf. They are ready for you to choose which ones work for you. The financing's in place, the third-party reports are in place, the closing has been done, and you just get to choose instead of having to say, I've got 45 days, I've got to get my survey, my title, my building condition report, my phase 1 environmental. There's so many things to try to get done during that time, and this just takes that closing risk off the table. On an amortized loan, some of the properties will have debt that amortizes, and some will have debt that is interest only for the whole period of the time frame. And there are benefits and weaknesses for each. And so if there is an amortizing loan on the property, then yes, you would receive your pro rata portion of the principal pay down. So if it started out, you put in $500,000 and you had a $500,000 loan attributed to you on a DST, over that 10-year hold, at the end of the time, it might be that the loan is paid down to $480,000. And so that would be your portion of that would be definitely applied to you. The typical loans to value on DSTs are between 50 and 60%. There are outliers. So we have properties that are in the 30% loan to value, 37% loan to value, and we also have properties that are over 60% loan to value. So that allows us to craft a sample portfolio for you to show you how you could use up your debt, match your debt in your 1031 exchange using DSTs, and also be able to stay perhaps all cash debt free on some of the properties in the exchange. We like all cash debt free DSTs anytime you can, because basically it's hard to lose a building if you don't have a loan on it. There will be some way to find a way to pay the taxes on it, but there's no lender to take it back if you happen to lose a tenant and you need to take the time to re-tenant that property. When you have a all cash debt-free, there's no refinancing risk. So many of us have lived through the time where interest rates were 17 and 18%. If you're up against that kind of situation when the loan comes due, that's a real challenge. And we've also lived through times where there's just been a credit lockup. There's just not been credit available. So those are just reasons why if you don't need debt, you might not want to add it. You don't have cross collateralization. Sometimes in a portfolio, all the properties will be attached to one another. And if one of them doesn't do well, the others will feel the pain of that. And there's even something called a cash flow sweep. That's really a sneaky little thing that gets into some loans. And it came up a while ago when Family Dollar and Dollar Tree merged. It affected their credit rating for a while. And so that little known cash flow sweep option or clause that was in some people's loans meant that the bank could hold your money instead of you holding your money. And they held it until the situation got resolved. So you're still earning that money, paying taxes on that money, but you're not getting the use of that money. So the balloon payment, the prepayment penalties, fees, all those are reasons why debt-free DSTs might be a good option if you are able to do it. If you have a loan on it, then what we're going to do is make sure that you get your loan replaced if that's the way you want to do it instead of bringing cash to the table. So closing, I mentioned that having the DST really helps with that closing risk, and the closing risk is mitigated. Usually you can close on a DST property within 3 to 5 business days. So because it's prepackaged, you can see those reports. You can look at all the third-party reports ahead of time to make sure that the due diligence is in your favor. I mentioned here and there about the different types of properties that are available, but it's just about across the board. Some of the properties we're going to say are properties that we're not going to represent, and those would be things like hotels or nursing homes, assisted livings, dementia units. All those are just fraught with not only legislation, but litigation. And hotels, as we know right now with COVID, are just really challenged. So we've never offered hotels and we won't. But there are a number of asset classes that you'll be looking at, whether it's multifamily or triple net properties, the GSA lease buildings, medical. We're not right now encouraging student housing because of all the unknowns. And in the bottom right here, I do mention zero coupon, which is an interesting animal. You wouldn't really be interested in that unless you had a specific tax problem, but it's one where all the money from the tenant goes to pay the mortgage. And so it helps with a tax situation, but it's not really something that most people would enjoy owning. And who qualifies? So in order to invest in a DST property, you have to be accredited. You can be either an accredited investor or your entity, your LLC or your trust has to be accredited. And it's typically defined as somebody who has a net worth of greater than $1 million, not counting their home. If it's an entity, each of the owners of the entity has to be accredited, or the entity could have gross assets of over 5 million. And these are hard and fast rules. If you don't have that $1 million net worth, or 200,000 in income, 300 with a spouse, then DSTs just wouldn't be for you. So it's something to check out ahead of time. And if you're not sure, you can ask your CPA or attorney to help you find out, or we have a form that you can review to give you more detail on that. On typical DST properties, what we have are, as I mentioned, just across the board. FedEx is a popular tenant right now. They're doing so well right now with COVID, with the pandemic, with everybody ordering in. And they're just hiring like crazy, and they are a good tenant, credit rated company, nice long lease. So it's something to consider when you're looking at DSTs. We have multifamily, both with debt and without debt. So in this particular one, it was a $25,000 minimum where you could get into a townhome project. And so doing something like multifamily or self-storage actually gives you a bit of a hedge against inflation, because you can adjust the rents monthly in self-storage. You can adjust the rents annually in multifamily. So if we happen to get inflation again at some point in our lives, then this is something that you'll maybe want as a part of your portfolio to balance it out against the triple net properties. Triple net properties are typically for 7 to 10 years or longer. So that means your income from that is going to be fixed, much like a bond is fixed over that time period. You can't just arbitrarily have them pay more rent. So until the lease comes due, it would be fixed at a certain amount. Sometimes there's escalations in the rent that are scheduled in the leases, but other times they'll be flat for the whole term. We do medical. You'll often see Fresenius dialysis, DaVita. Fresenius is the largest in the world. DaVita is second. And also properties like urgent cares or other medical buildings will come under the DST structure. We have pharmacies. A lot of people are familiar with triple net properties, whether it's a Dollar General or a pharmacy or some other kind of triple net property, and those do make good DSTs. They're typically easy to maintain or to manage on your own with just a few blips every now and then, like the Starbucks I mentioned. But sometimes it's hard to get in, or you might not want to put $5 million in just one building. By putting it into a number of buildings, you have that diversification that we talked about earlier. Medical, I mentioned, Frito-Lay was right here near me in Northern Virginia. This was one right near the Dulles Airport. Again, just a good, solid industrial building. This one had a PepsiCo guarantee. So a strong corporate tenant, nice long lease. Building that would be easily re-tenanted if they do happen to move out at the end of the lease. What we look for is the rent being reasonable. So they're not paying $25 a square foot when the market rent is $5 or $7, something like that. So pharmacies, again, we have plasma. I mentioned medical office. This is a type of medical office where they collect plasma. And then data centers. I didn't mention that earlier, but data centers are a big asset class now that are very interesting. They are buildings that are kind of single tenant buildings that are specifically built for the data center often, but I don't think we'll be needing any fewer data centers over the time frame that we're all looking for in the future. What we do on due diligence before we put the property on our platform and before we would allow you to invest in that property is really pretty extensive. So we're going to be looking at the property from lots of different angles before we turn it loose, basically. So our team will go through the properties and also go through other third-party reports that we have access to put together a comprehensive report on each property. It's kind of interesting that we actually send someone to see every property that we have on our platform, even if it's a portfolio. Sometimes there are portfolios of DSTs where you'll have 25 different single tenant net lease properties in one DST. So you're diversified right from the start because of so many different properties, but we do send someone to see each and every one of those so that we have a clear understanding of what that looks like. That's not our mystery shopping. Our mystery shopping is actually going in on some properties. We want to know, how is the leasing manager doing at that apartment complex? Or is that building really as needed as they say it is in a mission critical type property? We have databases, we have the third-party reports, we have access to appraisals, and so we put together a report that you can see that covers all that information. In this particular report that we're going to go through fairly quickly, it has a number of slides because there's so much information that we gather, and we'll touch on a few highlights. But this particular property is, again, near me in Leesburg, Virginia, just west of Washington. It was an apartment complex, Class B apartment complex. Class A would be a brand new building that's pretty fancy and maybe marble here and there. But Class B was probably the Class A apartment complex of its time. And now it's just a good, solid building with some room for value add. So the reports that we have will actually touch on things like sales comps. It'll touch on rent comps. We'll be talking about sponsor estimates, sponsor pro formas. We stress test the assumptions that the sponsor will give us. We look at when the property was built. We look at how it's been maintained. We look at the current condition of the property. Will the reserves that the sponsor has put into place, will they cover what we think is going to be the building needs from the building condition report for the 10-year hold? We look at sales trends. We look at the competition, whether there's competition coming to the area. We compare the acquisition price to the appraisal price. When we get into the building condition report, there's just so many things to consider. Again, because you want to make sure that there's a way for the reserves and the income coming in to be able to repair or replace or maintain the property or any of the shortfalls in the property. Again, if it's an older property, you're likely to have some interior and exterior items that will need some attention. The goal of a DST is basically to preserve capital and then to provide income. So even though a property might be a value add play, it's really something that it's not going to be a value add play where they're going to be building on a new wing on something. It's more value add where the exteriors are already nice, but let's go through and add new equipment to the gym, or let's go through and they will put in new appliances, new backsplashes and flooring to be able to upgrade and modernize the property to make it be more valuable when the time comes to sell. There's just so much information on every property. So what we do in the, I'm just going to flip through here quickly. So basically the due diligence process starts with our asset class rejection. I mentioned that we don't do certain property types because they're high risk. If we wouldn't want to be in there. We don't want our clients to be in there either. We do, as I mentioned, visit every property that we have on our platform. We crunch the numbers. It's kind of what we do. I've been in real estate since '79. So real estate is location, 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 but it's also the numbers. You have to buy a property well in order to be able to sell a property well. And so the stress test and the analysis on the property is so important. It's important to see what the worst case scenario would be. I mentioned that in some cases we are thinking in terms of what if we have to re-tenant that building? We want to know that we would be able to do it at a price that was still in line with the projections of the property. Leases, we do a lease analysis. There's so many things that are hidden in the lease that you might not know about. Things like a property having the tendency, or the property having the right to go dark if someone in the shopping center goes dark, meaning closed down. We want to find out what the landlord responsibilities are. Will the lease hold value? In some cases, it'll be hidden in the lease or in the PPM, the private placement memorandum, where we get a lot of our information. It'll be hidden in there that it's not a fee simple property, that it's just a leasehold, meaning you don't own the land, you just own the building. So these are all the kinds of things that we do because we are real estate people. These are sold as securities, but we are real estate people to start. And that's what we think is the most important piece of the puzzle. We have a team where we have in-house counsel, we have in-house due diligence, in-house CPAs, we have everything that we need basically under one roof. So if you happen to have a question, or your CPA had a question about a DST or about their 1031, we would put your CPA in touch with our CPA, or your attorney in touch with our attorney, so that they can talk the same language. And I think that's really helpful in the DST world. And DSTs right now, I don't know if you've seen them advertised lately, but they are mainstream at this point. I think it'll be about a $3.5 billion industry just this year. It's been growing each year because of the benefits of the DST. And Dwight K. and K Properties is really has been interviewed lately on a number of different Forbes and Kiplinger Letter and others that you might find in your research on DSTs. And I talked a lot about Dwight and about K Properties. A little bit about us. We have headquarters in Los Angeles, but offices in New York, Washington, San Diego, just opened up a Boston office as well. We only do real estate. So a lot of financial planners or wealth advisors are going to be offering you stocks and bonds and annuities and puts and calls and all that kind of stuff, but we don't specialize in that. We only do real estate. We have over 114 years of real estate experience as a team. We're licensed in all 50 states. If you wanted to talk to attorneys, CPAs, qualified intermediaries around the country who have worked with us, we can set you up with that. And I hate to say it, but we're always available. We try to be there, not 24/7, but yeah, I guess we would be, especially in that last 45 days. When it's your 45 days and you have to get something done, we're going to be taking your call. We work as a team, so there's always more than one of us on your side. You can reach me, my assistants. We have a transaction coordinator that will be assigned to you. And so there's always someone you can reach out to get what you need. And we are, as I mentioned, hyper specialized, only DSTs, and that is what we do. We have our experienced team. We're picky. We just don't put every property on our market. We might like another, we might like a sponsor, but we like 2 of their properties and we don't like the 3rd. And so it won't be on our platform. We have off-market properties, which are really interesting. They're typically debt-free properties. Dwight K. realized that there are just not enough debt-free properties on the market. So we really look for properties that we can bring to the market. And these often are off-market, so they're exclusive to K Properties clients. And we really do value integrity first. our clients come first, our needs of our clients come first, and we care that they get the education they need to be able to make a good decision. We have, at any given time, probably 20 to 35 properties on the market at any given time. Some of them are almost sold out, some of them are just coming, but there'll be a good choice for you. As I mentioned, some are debt-free, some have debt on them, and we walk the walk. I got into offering DSTs because that's what I wanted to do when I sold my rentals, and that's what I've been doing, is investing in DSTs as I sell off my rentals, and even on some cash investments just because I like the properties. The process is pretty simple. We start out by talking, talk, finding out your situation. Then we do a preliminary sample portfolio to give you an idea of what your situation would look like. Then comes the due diligence, the talking about properties and structuring the DST portfolio to meet your needs. You can then meet us. We do virtual, we do team calls, we can meet in person. And when you're finished with your investment, as I mentioned, you'll have a transaction coordinator, you have us on your team, but our education doesn't stop then. We want to be the ones you come back to for your questions that you have or anything you need, whether it's end of the year process, how does that work, or whether it's just something monthly. We're always here to answer your questions. So you can get a book if you want. Let us know. We have a book that you can have. Our founder wrote it about 1031 exchanges. And I do want to leave a little bit of time for questions. So I'm going to now invite Ron to unmute and ask some questions. I'm going to stop sharing for 1 minute so I can bring up my contact information. So 1 minute. And I'll be back again.
Okay, thank you, Betty. I'm glad you mentioned to unmute. I forgot about that. So we do have a couple of questions from the audience,
All right.
and here they are in no particular order.
Okay.
Is there a particular time frame that a DST must hold the property and or sell the property?
No, there's not. And so what happens is each property is going to have its own business plan. So some of the properties might be where they are 3 to 5, 5 to 7, 7 to 10 year holds. And that's what they're going to hope to maintain. But there's no guarantee as to how long it might sell. The average hold period is maybe 6 years, 6 to 7 years, which means some sell in 3 to 4 years and some sell in 8 to 10.
How do you get out of a DST if the property isn't sold? Or can you?
Absolutely. Yeah, that's a good question. I'm glad you brought it up. I should have mentioned it earlier. So we have a secondary market, and it's not very robust because we don't have very many properties on the secondary market right now, or at all right now. But you could sell your interest to any other accredited investor, just the way you would sell regular real estate. You could just ask someone if they want to own what you own. And let's say you owned $500,000 in a particular property, but you only needed $50,000 in a hurry. You could just sell $50,000 of your share. You don't have to sell the whole property, which is a real benefit. We have a secondary market here at K Properties. So if you wanted us to, we would bring your interest, however much you want to sell, we would bring it to our database and bring you offers on it, just like the regular real estate market would do. Again, it can only be sold to an accredited investor, but we do have that in place.
Obviously, the tax laws are critical with respect to 1031 exchanges. Do you have any thoughts about what potential changes could occur in the 1031 laws with a new administration coming in next year? Yeah.
That has all of us looking at our 8 balls, and mine says, when I shake that 8 ball, mine says, you know, outlook hazy, ask again later. But the Biden administration has mentioned that they want to do away with the 1031 exchange for investors who have an income over 400,000 a year. Many of our investors don't have an income over $400,000 a year, so it may not affect them. Back in the 2017, the Jobs Act, Tax Law and Jobs Act, got rid of the 1031 exchange for personal property like art or fleets of cars or airplanes, and replaced it with a bonus depreciation feature. So you didn't hear very much about it because it seemed to be okay with most people that happened. It's been in the law since the 1919, so, and it's survived every challenge in the past. So we're hoping it'll survive this challenge, or maybe just be amended a little bit, but there's really no way of knowing. If it did happen, it would really wreak havoc on the economy. I've heard all kinds of reports of how many trillions of dollars would be lost because people would just say, I'm not selling. If I have to pay taxes, I'm just going to sit tight. And if you sit tight on a property, that means a lot of people aren't going to be put to work. Usually when you buy a property, you do all kinds of new construction, fixing it up, painting it. Lots of subcontractors will come in, not to mention all the people involved with selling the property and title searches and surveys and appraisals and things. So I think it would really hurt the economy if we got rid of the 1031 exchange.
Is your business as active post-COVID as it has been pre-COVID?
It really is. And I don't know if everybody's heard, but my business happens after a qualified intermediary gets their investor in place. A lot of people right now are selling off single family homes because there's record highs right now with the interest rates so low. People are still buying. Maybe it's the stimulus money where people had extra dollars to be able to buy a home, but the market is still really strong. Properties, or many people would have thought that there would be blood on the streets by now and property values would have plummeted, but it's not the case at all. There's a flight to quality. So we're seeing things like, excuse me, triple net properties like McDonald's and CVS and Dollar Generals. The cap rates are actually compressing, which means the prices are actually going up right now. So it's an unusual world. Stock market continues to do well, or at least last time I looked. And the real estate market continues to do well. We've had a very busy year.
With regard to pricing, obviously you see a lot of transactions, you see the closing statements. Are buyers and sellers coming together? Are they buyer and seller expectations of pricing a lot closer than they have been 6 months ago?
I think it's my gut feeling. I'm not really involved in that end of the real estate. So although I'm familiar with it, I'm hearing that a lot of buyers want the prices to be low. They want to get bargain basement deals, but a lot of sellers are saying, no, I'm holding off for my price. And it looks like they're getting their prices. So I think it's about the same as it was before.
Any particular areas around the country that are more active than others with respect to your business?
Well, California is always on the forefront of, seems like everything, but a lot of people are leaving California real estate now and trying to get in other areas of the country. The Sun Belt, we call them the smile states down in the South, are really popular. They're gaining population right now. They're gaining jobs. They're often business friendly. So a lot of people, a lot of dollars are moving toward the South as opposed to being in the Midwest or the Northeast. So I think people are leaving big cities right now. So the tertiary markets, secondary markets, even for multifamily, are strong right now.
And with regard to the definition of properties that qualify as like-kind exchanges, investors, if they want to, can buy into very unique, specific properties like car washes bowling alleys and things like that, they qualify?
They do. If you look at the definition of the 1031 exchange, like kind, it's as long as the property is held for business or trade or investment, then it would qualify. So a bowling alley is, as long as you're selling the building. If you were just selling the business, it wouldn't qualify.
I'm checking the chat just to see if we have any further questions.
Okay.
Yes, we got a few more. That's fine. Let me just read them.
Okay.
Can you finance your interest in a debt-free property?
Oh, that's how I would, if I were speaking to that person, I'd say, tell me more. Can you finance the debt? Well, see, a debt-free property means if you had, say you sold something for $500,000 and you didn't have a loan on it, you could buy properties for $500,000 without having a loan on it. So these properties don't have a loan on them at all. So there's no loan in that regard. If they're asking, could you take your DST interest to a bank and put a loan on your DST interest, not the sponsor doing it, but you? I've heard of a bank doing that in the DC area, but I didn't ever follow up on it. So I haven't looked that much into it. I would guess maybe not, but you could probably use it as collateral or something because it's just a regular asset. So I don't know if I've answered that question because it was a little vague.
All right, here's one that is very specific.
Okay.
Kind of as an example. If you sell $1 million property and have more than 60% of debt on it, do you still have to spend the $1 million?
Yes.
Okay.
That was pretty easy. So the rule is you have to replace the sales price less allowable expenses. So allowable expenses would be things like real estate commissions and grantor's tax, or just the cost of sale, not counting return of deposits or anything, but just cost of sale. So that person might have $980,000 in net proceeds to them, and they still owed $600,000 on the loan. So you have to take that difference between the 980 and the 600, so 380,000. They have to take that 380 and turn it into $1 million or $980,000 price. Point.
Anything else? That's pretty much the questions that I see in the chat. Anything else that you think our audience should know if they have an interest in moving forward with a DST transaction?
I mentioned briefly the qualified opportunity zone, and I don't think we have time to get into that today, but that's another option for people who have a capital gain. And it doesn't have to be just a real estate capital gain. It could be a capital gain from the sale of stock or art or a collection of cars. Any kind of capital gains could go into a qualified opportunity zone. And I'd love for people to give me a call if they have questions about anything that we talked about today or anything that we didn't really have time to get into today. Or you can reach out to any of our team members at the 855 number below, or look at our website, which will, there's just so many blogs and white papers and videos and different forms of education that you can review to really get a good understanding of it. If anybody wants a copy of this slide deck, I'm happy to email it out to you to pass to them, or to anybody individually if they just reach out to Betty at kpi1031.com, and I'll have that for them along with any other pieces of information. You can also see our inventory online, and we have also it's called a PPM, the Private Placement Memorandum, kind of like a stock, when you're looking at a mutual fund package. So you can see all those right online at our website. So you'll be able to look at the numbers and the projected income and the third-party reports and the growth of the area. Everything would be in that PPM.
Okay, Betty, I want to thank you for providing a very detailed description analysis on DSTs. I think you gave the audience a lot of good information with respect to not only what you do, but how they can take advantage of certainly the tax benefits that this particular program has to offer. So I also want to thank the audience for participating in today's call. Also would like to ask the audience members that if they have any feedback on the program, feel free to email me with any comments you have, positive or negative. If the audience has any future suggested topics that they would like to have us present, be happy to consider that. And finally, once again, I want to thank Betty and her firm for sponsoring the program. And certainly, I want to thank the Mid-Atlantic Real Estate Journal for literally becoming part of the process of programming in terms of being able to provide this program to our audience today. We are literally out of time. Again, I want to thank everybody involved for their participation, and I hope the audience does look forward to future programs that we will be presenting in the future. Betty, thank you very much.
Thank you.
Leah, thank you. And everyone,
Thank you.
have a good day. Thank you. Bye-bye.
Bye. Thank you.